That was where I was going. So what ended up happening, of course, all the central banks in the reaction to COVID printed just staggering amounts of money. And they actually figured out how they could generate inflation by printing staggering amounts of money. That's what happened. So now they actually reloaded. So I'm actually less worried right now.
So they've got more bullets.
They've got more bullets, right? Because the next time there is something in the financial system that truly breaks, they can cut rates again. And so we were at a dinner last night, all together, all three of us, and talking about where that is likely to happen. And I'm not making forecasts, but it's absolutely the case that the financial system is fundamentally unstable. A lot of people woke up to that in March this year when you started to see bank runs happening, and you realize, maybe the banking system is not as stable as they're saying. Well, guess what? It never was. And so it's just that it becomes obvious in people's consciousness when you see banks failing. But that contagion they were able to stop. And it was, again, because of the Fed putting the program in place where banks that had long-term U.S. treasuries that were trading at 70 cents on the dollar, they can take it to the Fed window and get 100 cents on the dollar loans to just bridge until those long-term treasuries that they bought in the rising interest rate environment lost a lot of value. That's just the bond math, time value of money. That it's not that the U.S. government is going to default. I do believe the U.S. will pay off all of its treasuries. The question is, will the dollars that they use to pay them off be worth anything when they do, right? But the point is that I think the U.S. will actually pay off those treasuries, and the Fed essentially just created a process where banks that have underwater U.S. treasuries can take them for 100 cents on the dollar, even if they're trading at 70 cents on the dollar in the market, right? That's effectively QE. It was a bailout for those banks that made that terrible decision. But you and I were talking on stage yesterday. What created that terrible decision? It's the bullwhip effect. It was during COVID that they printed so much money. And the way that mechanically, when you print money, it works is the cash gets injected into the banking system. No one during COVID had any confidence in the private sector. So they were buying treasuries instead of making loans to private businesses. And there were zero yields on short-term treasuries. So what did the banks do? They bought 10-year treasuries and 30-year treasuries. And then when the Fed started to take that money back, the staggering amounts of QE during COVID, it turns out that we've seen a big correction in the value of those long-term bonds. Like I said, some of them trading at 70 cents on the dollar. And if everybody wants their money back from the bank at the same time, guess what? The bank hits the wall, right? But the Fed was able to stop that contagion, at least temporarily, by creating the new program in March.
So did these banks essentially get rugged by the government in that they bought treasuries, long-term treasuries, under the belief that they would have a certain amount of value? Or is that the risk of bond trading?
So I don't believe that they got rugged. I think I've seen a lot of people say that that's what happened and it's the Fed's fault. No, it's the bank management's fault. Not all banks made that same decision. Many of them did, but they were taking on enormous amounts of interest rate risk, and they really knew it. And so when Silicon Valley Bank's management doubled down and took demand deposits for some of the hottest of hot money customers, which is tech companies, and put and invested in long-term treasuries. I mean, they should have known that there was a risk, and I guarantee they did know. They just decided to just do it.
Well, let's see how much I've learned here in my time, because sometimes we have these conversations over and over again with people, and it doesn't always land. But as my understanding is when they bought the treasuries themselves are fundamentally fine if you don't have to sell them. If you can carry them to duration.
It's the U.S. government IOU. Yeah.
So if you can carry to duration,
correct,
you're absolutely fine. But the problem is when the run went on the bank, that you have this duration mismatch.
Correct.
And so they had to sell them. And if you're fire selling them, they're underwater.
Right, at 70 cents on the dollar.
Because if you want, there's newer treasuries available with better rates.
Correct.
That's essentially what happened.
That's exactly what happened.
Right. Yeah. Okay. So that says to me that's a fundamentally risky business model, because essentially they can be a profitable business but go under due to this duration mismatch.
Correct. Yeah, it is. The banking business is a confidence game. And in traditional banking, where banks take in depositors' money, everyone thinks it's your money, and you can get it back whenever you want. But what they've done is turned around and made mortgage loans or student loans or car loans with it with some duration. And so it's fundamentally a confidence game because it's based on assumption that not everyone will come and get their demand deposits back at the same time. But when there is a bank run and everyone wants their demand deposits back at the same time, that's when the insolvency of the bank is revealed. And like I said in the beginning, it was there all along. It's just that people didn't think about it. And I think what's interesting about the Silicon Valley Bank situation is that it had predominantly Silicon Valley tech companies as customers. Nobody in the treasuries of those startups or CFOs of those startups was doing counterparty credit risk analysis, because if they had been, they would have been all over this. You know who didn't have problems? Large corporates, because large corporates have treasury departments whose staff does counterparty credit risk on their banks because they understand. And the FDIC is only insuring up to $250,000. Think about Apple. Apple has how many hundreds of billions of cash? Okay, that is all uninsured because it's only insured up to $250,000 even for Apple, right? So they have to actually do the real work, and they're all monitoring their banks. But who wasn't monitoring their bank? Obviously, were the Silicon Valley tech companies, and all it took was an email from Peter Thiel to spark that bank run.
Well, I mean, if I was Apple, if I had 250 billion, I'd probably be going straight to the Fed. Can we just have an account with you?
Well, you know what's funny is in the 2008 financial crisis, when I was working with corporate treasurers, I actually looked at that because Siemens in Germany got an account with the central bank in Europe, and it was not out of the realm of reasonableness that these companies that had big corporate treasuries would want to just get their own account at the central bank. The U.S. has a policy of separating commerce and banking, and there are good reasons for that. But long story short, there isn't any U.S. corporate that can get an account at the central bank. This came up when Facebook tried to do Libra, because the Fed really wanted a separation of banking and commerce. And the FT had a really interesting article that talked about how, they got all the way up to the top of the Fed, and it was the general counsel of the Fed who communicated very dryly from apparently reading a script. This was all described in the FT, that the Fed stands for separation of banking and commerce, and Facebook is not allowed to be a bank.
When the big corporates do the counterparty credit risk, how do they actually assess that? Are they not all functionally the same, and therefore, if there's a bank run, functionally insolvent?
Well, no. In the U.S., one of the things that non-Americans find weird about the U.S. banking system, among many things, but one of them is that there are so many banks in the U.S. There are 4,236 banks.
What do we have in the UK? About 10?
Something like that. Well, you do have the building societies, and we do too, though. We have the credit unions and savings associations and the like as well. But actual real banks is a huge number. And so we have a lot of small banks in the US, and they're basically talked about in three different categories. Community banks, which is the proverbial, one or two branch banks usually. And then the regional banks, which have, sort of $100 billion in assets. And then they used to call them the money center banks, and now they're called global systemically important banks. These are the global banks, the money center banks that do business all over the world and get involved in foreign exchange. They're also, all of them now, involved in investment banking and trading and derivatives and the like. So you can see there's a big differentiation between those three different groups of banks. So the big banks they're subject to higher capital requirements, and they have to hedge their interest rate risk. This is the biggest reason why the community banks and regional banks screwed up and the big banks did not, which is driving more deposits into the big banks. The big banks had hedged their interest rate risk. The community banks and regional banks didn't have to, so they didn't, and now they're in trouble. And you can see it in the stock prices.